Good evening, class, and welcome to our taxation class for professional level. Today, we are continuing on the topic we treated last, which is capital allowances. In the last topic, we solved a question and we saw how to do capital allowances when we were doing hire purchase. So today we are still continuing with that same whiteboard for a comprehensive understanding. So let's go to one question the question number 2 here. This one says that manufacturing company PLC has been in business for several years. Financial statements are made up to 30th June every year. The following acquisition of property, plant, and equipment were effected in the year ended June 30, 2014. So if it is effected in the year ended 2014, June 30, it then means that the year of assessment here is 2015. Year of assessment is 2015. What's wrong with this pen? Year of assessment is 2015. Let me get it down well. Year of assessment 2015. All right, so look at the items that were acquired. So these are additions at cost. Okay, the following disposals were made during the same year. Now, in disposal, we are told that a motor vehicle was disposed. It was acquired for 1,500 in the year ended 30th June 2012. What it means that it was acquired in the year of assessment 2013 and was sold for 2 million. So this is the cash received. So this is the cash value. The residue of the qualifying capital expenditure as at July 1, 2013. So this is July 1, 2013. This is the beginning of the year of assessment. So this is start of year of assessment 2015, because this will run from July 1, 2013 to June 30, 2014. So this is the start, and these are the balancing figures. So these are the tax written down values. So these are the tax written down values at the start of the year. Industrial building has 5 years more. That means we've used 5. We'll say 5 has been used, 5 is remaining. Plant and machinery has 2 more years. That means we have used 2 years, 2 is remaining. Motor vehicle has 2 more years. All right. Then we are told to compute the capital allowances for the relevant years of assessment. said relevant years of assessment. Okay, so we just only know that it's going to be 2015 year of assessment. If we decide to do in 2016, that's not a problem. Now, what I also want to say is that this vehicle that was acquired for this cost, it was used for 2 years before disposal. I need to put it in brackets. I will say used for 2 years used for 2 years before disposal. So it means that this asset was disposed before the end of the year. So we won't be calculating capital allowance on that particular asset that was disposed at the end of the year. So our aim here is to calculate capital allowances. And we have three things here: building, plant and machinery, and motor vehicle. So this is manufacturing company PLC. So we'll say this is study pack question 2. Study pack question 2. So this is study pack question 2. The name of the company again. What's the name of the company again? We are told is manufacturing company PLC. So I'll write it down here. Manufacturing company PLC. Okay, it's PLC. Then we are calculating capital allowances for the year of assessment 2015. So the computation of capital allowance. So computation of capital allowances for year of assessment 2015. All right, so that being said, we are going to arrange our layout in this form. So this will be our capital allowance. Capital allowance. Then we have motor vehicles, plant, industrial building. Motor vehicle, plant, industrial building. This is motor vehicle, plant, industrial buildings. Okay. Okay, this is plant and machinery. Yes, plant and machinery. Okay, so we have all of these here. And we already say investment allowance is going to be 10% here, but it does not reduce the value of the asset. Initial allowance is going to be 15%. This is 50, and this is 50. This rate will be given to you in the exam. Annual allowance, this is going to give you 10. This is going to be 25, and this is going to be 25. That being done, we can now maybe put 3 zeros here. Okay, so we know this is year of assessment 2015. So we'll say year of assessment 2015. It's as good as saying basis period will be July 1, 2013 to 30th June 2014. So this is the period we are looking for. We are told that we got residues. We are given residues. We call it the residues of capital allowance as at 1st of July 2013, which I say is the start of the year of assessment. We say buildings, industrial buildings. So we'll start with tax written down value brought forward. So that's the brought forward figure we are going to be putting now. Our brought forward is going to give us 10 million, 2 million, and 3 million. 10 million, 2, and 3. So this is 10 million, 2 million, and 3 million. So this is your tax written down value brought forward. Then we are told that we had additions. So we have additions in the year. Additions in the year. Okay. Additions in the year. So let me just put Y arrow to signify year. Additions in the year. We'll now go to see those additions we made in the year. This is 5 million, 1,750, and 35. 5 million, 1,750, and 35. So this is 5 million, 1,750, and 35. Now, because we have an addition, we'll start with investment allowance. Investment allowance. Of course, investment allowance we said is going to be 10% on plant and machinery. So, and it's not going to affect the tax written down value. So I'll just put dash in all of them, but I'll simply just do here, I will say 10% of 1,750. Let me write it clearly so that it will be appreciated. So instead of allowance, let me use allow. Investment allowance, open a bracket, 10% of 1,750. So it's going to be 175. It's not going to be put anywhere here. It's just going to be here. 175. This is because it will not be allowed to reduce the tax written down value. Okay, so the next thing to do is our initial allowance. Initial allowance. So simply look for 15%. Look for 15% of this 5,000. So what would that be? We activate our calculator. 0.15 times 5,000. That will give you 750. So your initial allowance here is going to give us 750. We put it in brackets. The next one will be 1,750. Initial allowance is 50%, so times 0.5. That will give you 875. So I have 875 here. Put it in brackets. Then the last one is still 50% of 3,500. 3,500 times 50%. That will give me 1,750. And I'll put it in bracket again. 1,750. Now I'm going to add all of these together in brackets, but my answers will be in positive number. So 1,750 is already here, plus 875 plus 750. You have 3,375. 3,375. That's your initial allowance. Before you calculate your annual allowance, you will need to now do your disposals. So we have disposals. So what is our disposal? Someone is asking a question that someone said, I thought that last year there was an amendment to the rate of capital allowance for plant and machinery, specifically relating to investment allowance. I thought that has been scrapped. Now that only affects the year 2023 year of assessment. It doesn't affect 2015 year of assessment. So if they scrapped it in 2023, you can't go back to 2015 to go and scrap it. The law is understood to begin as at when it is effective date. So if you are doing anything relating to 2023 year of assessment, and it's not even the whole full year, there was a particular date it's going to start from. So in your exam, you will not be thinking about all those scrapping off, because a law has to stay 6 months in effect before it is tested in exam. So anything that happened for this year of assessment Don't think of bringing it in the exam. Just know it for your knowledge sake. So right now, look at disposals. Now, we are told that motor vehicle acquired for 1,500,000 in the year ended 2012 was sold for 2 million. Now, this 2 million is not your disposal. This is your cash price that you received. You need to look for the disposal at cost. So what are we going to do now? We are going to do workings here. I will say workings. Let me go down. I will come back to that. Then I will say this is annual allowance. I will do another workings. And after there is an annual allowance, we will now have your tax written down value. We call this one tax written down value carry forward. So this is what we are going to be carrying forward to the next period. Then you will now find your total capital allowance. So your total capital allowance will be what will be here. So of course, so before I put the total capital allowance here, it's possible that we might have balancing allowance. We know there is a disposal. There's a disposal. It's possible we might have balancing allowance. So I can come here and say balancing. Oh, that would have been before the tax written down value. So let's set the template right. So we will now have balancing value or balancing allowance. Normally I would have even written it before the annual allowance, but it's not a problem. Then we have tax written. I can even do my total capital allowance before my tax written down value. Let the tax written down value be the last thing. And I can say this is total capital allowance. Then of course I have our tax written down value. All right, so we were stuck somewhere. Disposals. So I'll go down here and this is my workings. So this is workings. So I'll say this is workings. So this is for workings. So in my workings here, I will say workings number one, disposal at cost. Now look at motor vehicle. It was acquired 1,500,000. Okay, so I will say motor vehicle, and I will say cost of assets 1,500,000. Okay, I think I should have put these three zeros up so that our answer should be consistent, because we have a 30 up here. So let me just put this 30. So this 1,500,000, right? That's fine. And we use the asset for 2 years. We established that before it was disposed. So this asset was bought for 1,500,000. We would charge, as at when it was bought, we had initial allowance. Initial allowance, which is 50%. So that would be 750. Correct? Then 750 will remain. We will now look for annual allowance. Annual allowance, it will be this remaining 750 divided by how many years motor vehicle is supposed to last? For 4 years. So this is the annual allowance for 1 year. But because we used it for 2 years, we are going to remove depreciation or capital allowance for 2 years. So 2 years capital allowance would have been claimed. So what it means here is this is 750 divided by 4. This is for 1 year, multiplied by 2. 375 would have been used. So this is the annual allowance before it was disposed. 375. So when we remove 375 from 750, 375 will remain. So this is 375. This is the tax written down value before disposal. So when we are disposing the assets, it means we are removing this cost of the asset from our books. So we'll come back here, disposal. Let me amend this onto workings number 1. So disposal, workings number 1. Put dash here, it was not disposed. 375. Is it 375 we got there? No. All right, 375 was disposed of. So this is the cost of the disposal. Okay, nothing was disposed here. Now your annual allowance is now going to be workings number 2. So your annual allowance here, say look at workings number 2. Annual allowance annual allowances. Okay, so I will do all of them here So this is supposed to be industrial building, plant and machinery, and oh sorry, wow, motor vehicle. This figure I put here was wrong. I should have put it where there is motor vehicle. Okay, so there's a dash here. So this is dash. The 375 should have been here. This is where motor vehicle is. All right. So what do we do now? This plant and machinery, and this is motor vehicle. Okay. I'll simply do I'll do workings again to get that. So this is going to be tax written down value, as if we are doing the same thing again. 10 million. Okay, let's not do it that way. Let's do it this way. Let's do it this way. Instead of starting tax written down values, let's start with additions, costs. So what was the cost here? 5,000,1750,35. 5,1750, 5,1750, 35. I think that's it. Initial allowance 750, 875, 1750. 750, 875, 1750. So this is the initial allowance. So what will the remainder be? I'm going to calculate it. 5,000 minus 750. That will give you 4,250. 4,250. Then we have 1,750 minus 875. That will give you 875. Then we have 3,750, 35 minus 1,750. That will give me 1,750. Okay? Because those ones were done at 50%. The next thing to do, this is the tax written down value, or this is, I'll call them um, capital allowance claimable, capital allowance, or annual allowance claimable. Let me use it that way. Or I would have said capital allowance claimable annually. Capital allowance claimable annually. So this is your annual allowances that you will be claiming. Okay. So what is going to be the annual allowance for this year? Annual allowance is going to give you at this first one is 10%, the other one is 25%, and the other one is 25%. So what it means that you calculate 10% of this figure, that will give me 425. Okay, so this is just for calculating annual allowance. So let me close this one here. This is your annual allowance for this year, 425. This is supposed to be 25%. So let's check 25% of 875 times 0.25. That gives me 218.75. 218.75. And let's look at this other one. 1750 times 25%. That will give me 437.5. 437.5. And that's not all. You will now bring the other ones here. These are tax written down values. So that means these are assets. What we only did was the new asset that we bought. We've calculated their annual allowances. So these are annual allowances on additions that we bought. Then you will say annual allowance on existing assets. So we'll take them one by one. We have 10 million here, and we said how many years remaining? 5 more years remaining. So you will come here and say industrial building is going to give you 10 million or 10,000 divided by 5 years. So that would give me 2,000. So 2,000 is the annual allowance for this year. So that means we are taking to 2,000 for the next 5 years. I'll do the motor vehicle last. So let me just do plant and machinery. Plant and machinery, we're told, is 2 million and 2 more years remaining. So it simply be 2,000 divided by 2 years remaining. That will give us 1,000. Then motor vehicle. Okay. Motor vehicle, we have 3,000, right? And 2 more years remaining. So what we'll do now is we will say 3,000, but mind you, this 3,000 is the tax written down value, this 3 million, all right? Is the tax written down value. And we have already disposed one of them. We have already disposed one of them. So that one we have disposed of, we are going to remove it because we won't calculate the annual allowance on it for that year. So what it means is that for that year, the cost of that asset that was disposed of will need to be deducted because that asset did not survive to the end of the year of assessment. And we've calculated that disposal to be 375. So simply say 3,000 minus 375, all divided by 2 years remaining. So what we'll do now, we will say 3,000 minus 375 that was disposed, then divide the remainder by 2 years. That gives us 1312.5. 1312.5. So that's what we'll do. 1312.5. 1312.5. So that's our annual allowances. So you will now calculate the total annual allowance. So whatever we get here, we are taking it out up there. So this is going to give it 2,425. 2,425. This is going to give me 1,218.75. 1,218.75. And this is going to be a calculation. Let's add. We already have this figure in our calculator. Plus 437.5. That gives me 1,750. So this is going to be 1,750. All right, so we'll take them straight. I remember the figure here, 1,750. So let's take it straight down here. 1,750 will go here. 1,750 will be here. 1,218.75. 1,218.75. Then we have 2,425. 2,425. All right, so we will now add them up together to get our annual allowances. I already have 1,750 here, so I will just go ahead and add 1,218.75 plus 2,425, and that will give me 5,393.75. 5,393.75. That's your annual allowance. Then we have our balancing allowance. Balancing allowance will only come when we dispose of an asset. So at this point, we don't know if there will be a balancing allowance. We don't know if there will be a balancing allowance. Sorry, I'm not supposed to calculate this like this here. So this is total capital allowance. So it's just here. I'm supposed to give my figure here. So all I will need to do now is to just get my tax written down value here, which I don't even care. We'll do that, but balancing allowance will be workings 3. So we'll go to workings number 3 to do our balancing allowance. So workings 3, balancing allowance. So we say there's going to be a balancing allowance if the tax written down value is higher than your cash received. If the tax written down value is higher than the tax cash received, then there's going to be a balancing allowance. Otherwise, if it is lower, there will be a balancing charge. So this is for motor vehicle. So the first thing to do is tax written down value on motor vehicle disposed. So what was the tax written down value? I know the figure 375. 375. What it means that if you had not disposed of this, you will be getting 375 for the next 2 years. So you will not say cash received on disposal. What is the cash you received on disposal? For 2 million. For 2 million. So because it was sold for 2 million, there will be no balancing charge or balancing allowance. There's no balancing allowance. The balancing allowance is 0. But there will be a balancing charge. But we are not asked to do all of that. The balancing charge will be the difference. So, but we're not asked to do that. So we just go front here and indicate our balancing charge to be 0. And here is 0. So the next thing to do is to calculate our capital allowances. I already have this in my calculator. So I'll go up plus 3375 plus 175. Okay, so that's all. We have 8943.75. 8943.75. 8943.75. So that's your capital allowance. If you think you have time, go ahead and give them your balancing tax written down value is going to be carried forward. The exam, please don't do it. It won't give you any mark. Don't do it. So, but we'll do it here. 10,000 plus 5,000 minus 750 minus 2425. That will give me 11,825. 11,825. We'll do the next one. We have 1,750 minus 875 minus 1218.75. That will give me Okay, I've not added this 2 million. I'll start again. 2 million. I was wondering why I was getting negative. My plus 1750 minus 875 minus 1218.75. That will give me 1656.25. 1656.25. And the last one, we have 3000 plus 35 minus 1750 minus 375 minus 1750, 2625. So this is 2625. So that's it. Your capital allowance is 8 million for 943 or 944. So that's it. That's how this question is going to be solved. You may see a different or slightly different method here, but we are getting the same thing. We have a balancing charge which we didn't bother. We have a balancing charge which we didn't bother. So take time to compare the solution we did here with that in the pack. All right, so that's one. We've seen that when an asset is remaining, the lifespan of the asset is remaining, the number of years is remaining will be used to divide the tax written down value to know how much will be calculated as depreciation. And we now also know that when an asset is being disposed of, the asset is going to be excluded from the capital allowance calculation, annual allowance calculation. All right, so we'll now look at a past question. Let's see how a past question. Now look at May 2019, question number 3. So we are going to be looking at question number 3, May 2019. May 2019, question number 3. So I would say this is A9 because this is our 9th class. Call it A9. All right, so we have it here. May 2019, question 3. Pado Nigeria Limited is a manufacturer of polythene bags. Now, because you have had them mention manufacturer, what comes to your mind is capital allowances will not be restricted. So you say CA not restricted. All right, so let's go. Pardo Nigeria Limited is a manufacturer of polythene bags. It was incorporated on January 1, 2013, but commenced business operation commenced on March 1. So we don't look at the date of incorporation, is the date of commencement. The following is a summary of its adjusted profit for the respective years. So what I will do here, because they are giving us to December 31st, that means it's normally running from January to December. And so this is going to be, I'll put year of assessment here. This is going to be 2014. This is going to be 2015. This is going to be 2016. This is going to be 2017 and 2018. So that's what I will do here. These are the year of assessment. The company acquired the following assets. So this is the date they acquired these assets. So what we'll do now is we'll put year of assessment here. Year of assessment. This asset was bought in 2013, so it's going to affect 2014 year of assessment. This is going to affect 2015 and also 2015. And this is going to affect 2016. All right. Then these are disposals. The company sold some of its assets on December 31st, 2017. So it means that the date in which it was sold off is the last day. So annual allowance would have been computed. So I will say sold on last date, compute annual allowance. Now, we said that now we're going to be using the new rule. We will not mind if this was done before before Finance Act 2019. Okay, so what I would say is that if I say before Finance Act 2019, this March 1, 2013 falls under year of assessment 2013. But from Finance Act 2019, this March 1st, 2013, we assume that it is Finance Act compliant and it will be year of assessment 2014. So 2014. So based on this assumption, the solution you are going to be seeing here will be slightly different from what you have in your pack, in your Pathfinder, because we are assuming that we are using Finance Act. All right, so the company sold some of these assets. So how many? This is 2018 year of assessment. So this is year of assessment 2018. Okay, somebody is coming with question. Someone say, please explain the rule again. The rule of what? I don't get it. The rule of what? Could you be specific? The rule, is it the old rule or the new rule? If we are solving with the new rule, I will explain it as we are solving it. All right, so this is year of assessment 2018, and this asset was bought in year of assessment. Okay, no, we didn't know when it was bought. Okay, so we look at when it was bought. So here, office furniture was bought in the year of assessment 2015. So I will say number of years used. So this office furniture was this part of the office furniture that was bought for 2,750. Look at the cost of the asset that was disposed. It was bought in the year of assessment 2015 and is sold for year of assessment 2018. We have used 3 years. We have used 3 years. Production plant was bought in 2016 year of assessment, and so we have used 2 years. All right. So we've done all the necessary workings in our book. In the exam hall, I wonder if you'll be allowed to be making these markings on your book. But if you're not going to be allowed, you may need to make some small jotting on your answer script in pencil, which you can later cross back. If you want to even write them in biro and cross it later, then it's fine. If you want to leave it, if it will attract marks for you, it's fine. Now, as a newly appointed tax consultant to the company, the managing director sought your advice on both capital allowance available to the company and the tax liabilities of the relevant years. He has informed you during the time of finalizing the engagement that the factory building was purchased second-hand. Factory building was purchased second-hand from a company that has ceased operation 6 months earlier. So if a factory building was purchased second-hand, what it means is that no initial allowance claimable. Only annual allowance will be claimable. Okay, so having done all this, prepare a report addressed to the managing director of the company showing for all the relevant years the capital allowance computations, the tax liabilities payable. So in your exam, you just leave one full page for your reports. Then the next page, use it for your workings. So I'll go to this page here and I will start with our workings. So what's the name of the company again? The company's name is, sorry, this is not it. What am I doing? Okay, Pado Nigeria Limited. Let me take the whiteboard to this side so that it will be easy. Pado Nigeria Limited. May 2019, question 3. I wanted to write ICANN. ICANN ATAX past question. Okay, we'll say Pado, is it manufacturing or Nigeria Limited? Nigeria Limited. Nigeria Limited. So we'll say we assume that all computation conform with Finance Act 2019. Now, this should not be done in the exam because you are not supposed to assume. We are just using this question to explain how to do the new rule. Okay? They will not give you a question that is going to be with the old rule. So we're using this one to pretend as if it is a new one. So we are looking at it as though we are assuming like if all of these things instead of 20, 2024, 2025, 2026, 2027, that's the kind of thing we are looking at. We are assuming like that. That's the only way it is going to work. So after doing that, we are asked to calculate our tax liability and capital allowances. So first question is saying capital allowances, 9 marks, tax liability payable, and we have what do they call that? There's no loss. Okay, so what we'll do now is we'll set our template. So this is going to be year of assessment 2014. 2014, that is when the company started. 2014, and we're going to do up till 2018. 2014 to 2018. So what we'll do now, this is year of assessment 2014. The company started from March 1, 2013 to 31st December 2013. So we will say adjusted profit. Okay, so let's put the adjusted profits. We've got adjusted profit is 7,200,000. So the new rule is saying here that because we are using preceding year basis, your first year will start from the date the business commences and will end in the first accounting period. So your accounting period started from March 1 and ended in December 31st of the same year. So that's why we use that basis period. So it's 7,200,000. So that's 7,200. We put it that way. 7,200. So that's the adjusted profit. So we will say less capital allowance. So I will come here. It's going to be capital allowance claimable. So I'm going to put 2 naira sign again. Capital allowance claimable, we don't know. It's going to be in workings. Let's say workings 1. Then we will say capital allowance charged. We need to know how much is going to be charged. So this is the amount that is going to be charged. After that, there will be a line. Then there will also be a line here. Then we will say capital allowance carried forward. So this is what will be carried forward if there is any. Then we will have our taxable profit to be here. Then we will say CIT at 30% of taxable profit. Now we are assuming that this business is having a revenue of over 100 million. You know, in the time this question was given, every tax rate was 30%. There was nothing like 25% threshold and all that. So we are going to assume that this company passed the threshold of 25 billion. In fact, it's past the threshold of 100 million. That's our assumption here. I will just say assume. Let me state the assumption here so that we'll save ourselves stress. Assume company's turnover exceeds 100 million naira. We'll just write this assumption once, and that's what we'll be carrying for with all questions here. So the next one would be tertiary education tax. At the time this question was given, tertiary education tax was 2%. We'll assume 2% because this was a 2013 question. But in 2023 year of assessment, capital allowances was 2.5%. I'm sorry, tertiary education tax was 2.5%. So, but we will want to use the 2% to conform with the same thing they have in the exam pack, because as at that period, capital I say, why do I keep saying capital allowance? Tertiary education tax was 2%. So let's just use that 2% of just the profit. I will put my assumption here. Assume TET was 2%. Of course, if they change the dates of the question to suit modern time, you will no longer be using 2%, you'll be using 2.5. So, but as at the time this question was solved, the prevailing rate was 2%. So, you would have calculated this and this. So that's your tax for that year. The next year will be year of assessment 2015. And that will be from January 1, 2014 down to December 31st, 2014. You underline it. Then you will start with your adjusted profit. Your adjusted profit. So you come up here and check your adjusted profit, 10,700. Simply write 10,700. Then we will say less capital allowance, less capital allowance. So how do we do that? We'll bring capital allowance brought forward, capital allowance for the year, then we'll say total capital allowance claimable. Total capital allowance claimable. Then we'll say capital allowance charged. Then after that, you will now have capital allowance carried forward. Next thing will be taxable profit. Then we will say CIT at 30%, TET at 2%. So we've done the second one. We will now do like that. So what I will do here, I want to go straight to the workings. I will give enough of room. I will give this whole page and I will start my workings here. Let's see how we can manage our workings. Let's say this is workings. Will I even say workings? This is computation of capital allowance, so it's not workings. Just say capital allowance computation. So this is capital allowance computation. So we'll bring those assets down now. Where are those assets? We'll start. This is factory building. office furniture, motor vehicle and plant. Factory building, office furniture, factory building, furniture and fittings, motor vehicle and production plant. Motor vehicle plant. Now say total CA. All right. So I will start with initial allowance rate is dash 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 10%. Oh, investment is investment allowance rate. And the next one is initial allowance rate. Factory building is 15. Furniture and fittings is 25. Motor vehicle is 50. And plant is 50. Annual allowance rate, this is 10. This is 20. This is 25. This is 25. So now that we've got that out of the way, we can put our Naira sign. All right, so we will start with year of assessment 2014. So in year of assessment 2014, this asset, factory building, was purchased. Factory building was purchased. So how much was the price? 5,400,000. So as we are using these figures, we are shading it 5,400,000. So we say 5,400,000. Oh, sorry, I should have started with cost. We'll go down here and say cost. Cost 5,400,000. These ones were not bought. And we were told that this factory building was purchased second hand. So we will not claim initial allowance. So what I will just do here, just for formality, I will say initial allowance. Let me write initial so that we will not confuse it with investment. Initial allowance is going to be dash. I'll still put a dash here, dash here, dash here. Annual allowance. This is going to be used for 10 years. So we'll just do the calculation. Let's just do it here. 5,400,000 divided by 10 years. Now, how many years did we use these assets? how many months? It was bought in April. The business started in March. So we used it for 11 months. So we will now say multiplied by 11 over 12. So what we will now do here is 5,400,000. That's the second-hand cost, depreciable value, divided by the 10 years we are going to use it, which is going to give us 540, and we use it for 11 months. So we say times 11 divided by 12. So 495 will happen to be our annual allowance. 495. So this is dash, this is dash, this is dash, 495. As we're doing all of these things, take note when we get to the year 2018, which is the last year, disposals is going to be done. Okay, so what will happen now is this is our capital allowance for the year. So we'll just take it up down here. Let me just rule this line again. Let me just rule all this line. So I'll just come here, 495. Now say capital allowance, 495. I'll take it up for the year 2014. So this is going to be 495 is the claimable amount. Yes, can we claim it? Yes, so we'll charge all of it. 495 is going to be charged. 495. We are not restricting it. So carried forward here is dash. So what do we do here? We will say 72 minus 495. I have 495 already. So plus 72. That will give me 6705. So this will give me 6705. I will now look for 30% of that times 0.3. 30% of that is 2011.5. 2011.5. So that's your CIT. Then your TET, you just have to calculate 2% of this. So this is 72 times 0.02. That's 144. All right. You're done with the first year. We go to the second year. Capital allowance brought forward, we know is dash. We don't know capital allowance for the year. So let's go and do it here. We will now say year of assessment 2015. Tax written down value. We will now do our tax written down value like this. 54 minus 495. That will give you 4905. So this is going to give you 4905. Of course, there's a dash, dash, and dash. In that year, was there any purchase in 2015? Yes, there were two purchases. Two purchases. Office furniture and motor vehicle. Office furniture, 2750. So I will say cost. Furniture is the first, 2750. So of course there's no cost here. 2750. Motor vehicle, motor vehicle was, we've done this. Motor vehicle is 4500. So we'll do that now. 4500. All right. So there's going to be initial allowance. Initial allowance is going to be dash here. Then this is furniture and fittings. We said is 25%. So look for 25% of it. 2750 times 0.25. That will give me 687.5. 687.5. That's your initial allowance. Then this one here, initial allowance is 50%. So of course this is going to be 2000. When you add this here, it's going to give me 2687.5. Let me not forget that there is a point here. Two 687.5. All right. Then we have our annual allowance. Annual allowance. Of course, for this 409, we'll calculate it the way we did, but it will not be with 11 over 12 anymore. We'll go back and recalculate without the 11 over 12. We will say, okay, let me calculate for the sake here. We will say, let's do the workings here. 5400 divided by 10. So that will give me 540. 540. Okay. Then this other one will give us 2750 minus 687.5 all over how many years? This for 5 years. This is for 5 years. How many months was it used? Furniture and fittings. When was it bought? Furniture and fittings. Office furniture was bought in January. So we use it for the whole full 12 months. So we can either say times 12 over 12 or we ignore it. 12 over 12. Just to show that it was used for the whole full month. So you come and calculate it this way. 2750 minus 687 687.5. There should be a point here. 687.5 right, divided by 5, 412.5. So that's what we'll be taking every year, 412.5. 412.5. This other one here, we are going to calculate it as 4,000 minus 2,000 divided by 4 years. So that's motor vehicle for 4 years. How many months was it used? Motor vehicle was bought in December. It was used for 1 month times 1/12. So what you will do now is 4,000 minus 2,000 will give you 2,000. 2,000 divided by 4 will give you 500 times 1/12. So I will say divided by 12. That will give me 41.667. So that's what I will use. 41.667. Okay. So because I have done them in separate lines, I will just bring these figures here. 540, 412.5, 41.667. So my annual allowance is done here. Annual allowance is done. So you calculate your total annual allowance. So we have this figure already. Okay, since I've cleaned it, let's start. 2687.5 plus 540 plus 412.5 plus 41.667. That will give me 361, 3681, 667, 3681, 667. 3681, 667. So that's what we'll take. 3681, 667. 3681, 667. 3681.667. When you add them together to give me 3681.667, that's the total claimable. Can you charge all of them? Yes, because we have enough. 3681.667, 3681.667. So when you charge, this one will be 0 here. So nothing is carried forward. So but what would be your taxable profit? I already have this in my calculator. So I will just say I'll remove it from 10.7. And I have 70.18.333. All right. I will now look for my CIT of this figure. I'll multiply it by 30%. That will give me 2105.50. 2105.50. So this is your tax. Then your tertiary education tax is going to give you 2% of 10,700. 10,700 multiplied by 0.02. That will give you 214. So we have our 214 here. So we just finished 2015 year of assessment. We will now go to year of assessment 2016. Basis period will be January 1, 2015 to 31st December 2015. I like to underline them. Did I underline the other one? Yes, I like to underline them. So you will start with your adjusted profit. This adjusted profit can also be called accessible profit for 2016. Yes, 2016. So you see, it helps us. Okay, we've taken this. We've taken this. We've taken this. So now we are about to take this. 12. What's happening? We are about to take 12,650. 12,650. So we'll say this is 12,650. So that's your adjusted profit. I won't be doing this capital allowance very long like this. I will not bring capital allowance brought forward. I will just say capital allowance for the year. Okay, capital allowance for the year will now go down. So we are in 2016 now. So this is year of assessment 2016. This will be tax written down value. So your tax written down value will now be 4905 minus 540, 4365. 4365. We'll do the same thing here. Two 750 minus 687.5 minus 412.5. That will give us 1650. So that will give us 1650. 1650. Then here we have, instead of saying 4,000 minus 2,000, I will just say 2,000 minus 41.667, 1958.333. And of course, there is a dash somewhere here. Let me make this thing here so that it will be accommodating the next one that will be purchased. $19.50 what? 1958.333. Okay. In the year 2016, year of assessment, was there any purchase? Yes, the last purchase was made. Plant 1820, 1820, 1820. So you come here and say cost 1820. And so because there's the cost, we have our initial allowance. This will be dash, dash, dash. So initial allowance for plant is 50%. So let's look for 50%. That should be 960 or so. 1820 divided by 2, or say times, just say times 50%. 910. Oh, okay. 910. Then your annual allowance here, annual allowance. We've established this to be 540. So we'll put it there. 540. The other one we calculated 12 over 12. We've established it to be 412.5. 412.5. This other one now, that was 1 over 12. We need to do this without the 12 over 12. Or we simply multiply this by 12. Anyone we do. So we simply say, let me do that one here again. 2000 over 4. I will just do it this way. 4000 minus 2000 divided by 4. It's the same thing as saying 2000 divided by 4. What did I do? 2000 divided by 4 will give you 500. So this should be 500. And now this other one will be 1820 minus 910 divided by 4. How many months was it in use? We bought it when? We bought it in January. So it's going to be for the full year. Uh-oh. I'll simply say times 12 over 12. So what do we do? It's as good as saying 910 because that was 50%. 910 divided by 4. 227.5. So let's just write it here. 227.5. So let's bring all our figures. Let me just put here 540, 412.5, 500, 227.5. I already have 227.5. I'll add 500 to it. I'll add my 412.5 here. Then I'll add my 540 to it. And we have our initial allowance, 910. Plus 910. 2590. So we have 2590. That's your capital allowance. So that's your capital allowance. Total capital allowance 2590. Two 2590. So it can be claimed. I'll just bring it straight here. 2590. It can be claimed, and no one will be carried back forward to the other year. So we have taxable profit. I had to do it the long way so that you will see how it is supposed to be done normally, because sometimes there may be figures in all these places we are putting dash. There may be figures, but also we realize that also we don't have a space, and also we know there is no figures. This is another way of doing it. So it's simply, I have my 2590 here. I'll take it off from 12,650, and of course I went to add 12,650 minus 2590. I have 10,060. 10,060. So I'm going to look for my tax, multiply by 0.3, 3018. So this is going to be 3018. So this is going to be CIT at 30%. Then of course we have TET at 2%. 2% of 12,650 times 0.02, 253. So you have 253. That year is gone. The next one is year of assessment 2017. Year of assessment 2017. Basis period will be January 1, 2016 to 31st December 2016. We rule them. Adjusted profits. We go back to this one. This is what we are using. 15220. We have 15220. We will now say less capital allowance. All right, so we'll go to the workings for 2017. A capital allowance question is a very tiresome question. If they are giving you capital allowance, just know that they want to waste your time. So you will say year of assessment 2017. Tax written down value so it will be 4365 minus 540. That will give me 3825. 3825. Write it down. 3825. Bring up your calculator again. You have 1650 minus 412.5. So your answer will be 1237.5. 1237.5. You go up again. You have 1958.333 minus 500 1458333. 1458333. Of course, you can convert this to the nearest whole number, but the reason why I put them 0.333 because I have 3 zeros up there. But of course, you can convert them to the nearest whole number. Nobody will penalize you in the exam. Even in real life, people do that. Then of course we have 1820 plus 910 minus 227.5. That will give me 2502.5. 2502.5. 2502.5. Alright, that is your tax written down value. Did we buy any assets in that year? We finished all our purchases, so we didn't buy any assets in that year. So we will not claim initial allowance. So we will say annual allowance. We've established this to be 540. So use the 540. We've established this one to be 412.5. 412.5. We've established this one to be 500 because it was 12 over 12. We've established this to be 500. And this last one, that was 12 over 12, We establish it to be 227.5. This one was easy. So we'll just calculate our annual allowance. 540 plus 412.5 plus 500 plus 227.5. That gives us 1680. 1680. So this is our capital allowance. Take it up. Yes, it can be claimable. 1680. We have it on our calculator here. So we'll just put this one here plus 15,220. That will give me 13,540. 13,540. So this will be your taxable, it's either called taxable or total or chargeable profits. Any of these names you use, you are fine. Either taxable or total or chargeable profit, just in case you see them in different names. Then your CIT at 30%. Look for 30% of this value. We have it in our calculator here times 0.3, 4062. Okay. Then your TET at 2%, 2% of 15,222. You calculate 220 times 0.02. That gives me 304.4. 304.4. Then we'll come to the last year, which is going to be year of assessment 2018. Basis period is January 1, 2017 to 31st December 2017. Then we have our adjusted profit. How much was that figure? 19,850. 19,850. So I'll write it down here. 19,850. Okay, so I will say less capital allowance. All right. So what do? We go back to workings. Okay. I will say year of assessment 2018. We have our tax written down values. Tax written down values, we We'll now calculate them. I already have this figure for the last one, so I'll just say minus 227.5. That will give me 2275. This is 2275. Okay, and I have 1458.333 minus 500. That will give me 958.333. So that will give me 958.333. The next one here will be 1237.5 minus 412.5. That will give me 825. That will give me 825. Then the last one will give me 3825 minus 540. And that will give me 3285. 3285. So let's check if there's any addition. There was no addition. But mind you, this office furniture that was bought in 2014 year of assessment, this is 2015, 16, 17, 18, okay, 15, 16, 17, 18, okay. This is the second to the last year before it expires. Motor vehicle also 15, 15, 16, 17, 18. So in this motor vehicle, this is the last year that it is supposed to be. This is the last year it is supposed to be. This is the last year. So normally what would have done here, this is how many years? This is going to be useful life. That's supposed to be 10 years. I will say end year of assessment should be 2023. Office furniture is 5 years, so we count 2015, 2016, 2017, 2018, 2019. So this one would have ended in 2019. This one is 4 years to end in 2018, and this one is 4 years to end in 2019. So motor vehicle is the last motor vehicle here is the last. And we have not disposed any of the motor vehicle. We use them up to the end of the year. So what we'll do, we will say annual allowance This one is still 540. Still 540. This one is the second to the last, so it's going to be 412.8. Sorry, 412.5. 412.5. Now, when it comes to motor vehicle, we're not going to use 500. Now, take note, when we did motor vehicle, because it was used for 1 month, if we remove 500, the remaining 458.333 is 11 months that was not charged. So, but this is the last year that it is going to be used. So what we will do here is we'll remove everything and less 10 naira. Some people might want to less 1,000 naira. So because we've approximated, let's less 1,000 naira. So all we need to do here is this is going to be 957.333. That is if we are lessing 1,000. Some people less 10 naira in the books. Why some just leave it at 1,000 naira? But normally, because we have approximated, if we have used this thing, okay, let me use 10 naira so that I'll be teaching you what is in the book. Let me use 10 naira, although some people use 1,000. I've seen people use 1,000. So this is 958.323. So that 10 naira will remain. And here we've established that this is 227.5. Let's add them all. Let's add them all. Five. Oh. Okay, I would have said 16, but let's add 540 plus 412.5 plus 958.323 plus 227.5. That will give me, let me write it down here. Sorry, I didn't get the figure. 2138, 232, 2138. 2138.323. So this is your capital allowance here. So I'll call it capital allowance. But that's not all. That's not all. We are told of disposal. Disposal costs. Now, how do we get our disposal at cost? How do we get our disposal at cost? Now, some of the assets on December 31st, some of the assets that were sold off on December 31st were as follows. This is the cost as at then. Okay, so I will go and use this side of the whiteboard so that we will not waste it. And I will say, we use a different color to calculate the disposal. Disposal, let me go down a little, because it's possible that, so let me say disposal here. Disposal at cost. So the asset is office furniture and plants. Office furniture and plants. So I will say furniture and fittings, plants. I will say date of acquisition. So date of acquisition here, furniture, 17th January 2014, 3 January 2015. 17th January 2014, 5th January 2015. Date of disposal, 31st December 2017. December 2017. Assets used for in years. Use it to 2014, 2015, 2016, and in 2017. So we use it for 4 years. And use it on 2015, 2016, 2017. 3 years. So we'll say cost of asset disposed. Cost of asset disposed, we are given I think there's a mistake. It's supposed to be just 250 without these thousands, because this is office furniture. This is 2750, and there's 1,000 up here. This cannot be 250,000 and there's 1,000 up here. So these 3 zeros are not supposed to be there. So we'll take it 250 and 600. So this is 250, 650. Now, as at the time we bought them, we will now remove the initial allowance less initial allowance. Note that for plants, it will never less the investment allowance, because investment allowance never affected it. So this is going to be, what's the percentage? Is 25%, and the other one is 50%. So we bring up our calculator again. 250 multiplied by 25%. That will give you 62.5. 62.5 will be the initial allowance for here. And this will be 650 times 0.5. 325. 325. That's the initial allowance. Then annual allowance before disposal. So annual allowance here will be 250 minus 62.5 divided by furniture and fittings is supposed to be 5 years. Now we have used it for 4 years before we dispose it. Then we'll look at this other one, 650 minus 325. A plant is supposed to be used for 4 years. So divide by 4, and we have used it for 3 years before disposal. So let's check the first one. Okay, I already have 325 on my calculator, so I'll just put the minus sign beside it, plus 650. Okay, now divide it by 4, and I'll multiply it by 3. So this is the annual allowance that has been claimed, 243.75. So here is 243.75. Let's see what this one will be. There is 62.5 in my calculator here already. Put my minus sign beside it, plus 250. Okay, now divided by 5 and multiplied by 4. 50. So 50 has been claimed here. 50 has been claimed here. So what will happen? I have this already. So let me add 325. Okay, and let me put a minus sign beside it. Then I will say plus 650. That way I've minus everything. So this is 81.25. This is 81.25. Let me do the same thing here. I have 50 here already. Let me add 62.5. We put the minus beside it, then plus 250. and that will give me 137,500, 137.5, 137.5. So this is your tax written down value before disposal. Then you say cash. Okay, so now because this is your this is your tax written down value before disposal. So this is your disposal at cost. So this figure 137.5 and 81.25 is what we need. 137.5, 81.25. The first one is for furniture and fitting 137.5, 137.5, 81.25. So that's my disposal cost. We'll come back to this disposal again. So because of this disposal, we'll check if there is balancing charge or balancing allowance. Let's check. So cash received at disposal. How much did we receive? 35 and 60. So we received 35 and 60. So the cash is not bigger than the disposal value. So what happened is we received something smaller. We received something smaller. If we have received something bigger, we would have said there is going to be a balancing charge. But because we received something smaller, then there will be a balancing allowance. So we have balancing allowance. So your balancing allowance here, I have this already, minus 60. That will give me 21.25. 21.25. I have this already, or minus 35. 102.5. 102.5. So 102.5, 21.25. 102.5, all right. 102.5, 21.25. So this is going to be our balancing allowance. So I will add these two together. 102.5 plus 21.25. That will give me 123.75. 123.75. So let me change the color of this pen now. I'll now calculate my total. So this is going to be 123.75 plus 2138.323, sorry, 323. That will give me two. I didn't get that figure. 2262.073. 2262.073. 2262.073. 2262.073. Take it straight down here. It's claimable. 2262.073. So that's it. So this is going to be your taxable profit. You calculate your taxable profit. I have this here, and I will say 19,850. That will give me 17,587. 17,587,927. So this is a taxable profit. So we have our CIT at 30%. So let's calculate 30% of that. So times 0.3. That gives me 5276.38. 0.378. 5276. Let's say 5276.278. I want to make them in 3 decimal places. 5276.378. 378. Then your tertiary education tax at 2%. So you see why you should give enough space for your job in working so that you will have good room for it. We have 19,850 times 0.02. And that gives me 397. 397. That's the tertiary education tax. Never come to do the tax written down value. You don't need it. We don't need this figure. We don't need it. We don't need it, but we are still calculating it. We don't need it. 3,285 minus 540 give us 2,745. 2,745. We don't need this figure. So this is tax written down value carried forward. We don't need this figure. Computing it for computing's sake, it will not add anything to your mark. 825 minus 412.5 minus 137.5 minus 102.5. That will give me 172.5. 172.5. So you see here, this is now going to be the next question. This was supposed to be the last year, right? This was supposed to be the last year. But because you have done this balancing charge, let me examine something. 125, you have disposed some of the assets. So normally it is this 412,050. You have to remove 10 naira at this time now, but you've disposed some of these assets. The capital allowance you are going to charge is this asset here remaining 10 naira. Just as we did this one now, 5958.333 minus 958.323. This is the 10 naira. So I will say 0.010. 0.010. So that's the 10 naira. If they were to convert them to thousands, then this one here would be 2275 minus 227.5 minus 81.25 minus 21.25. That will give me 2275. I did something wrong. 2275 minus 227.5 minus 81.25 minus 21.25. That will give me 1945. 1945. 1945. So these are the tax written down values. No need to do all of that. This is what you are told to do. So I will also advise you to do a kind of summary here. You will do a summary and you will say year of assessment. You don't need to put the basis period. You will say capital allowance, CIT, TET. So you will do your 2014, 2015, 2016, 2017, and 2018. You need to bring down their capital allowances, their CIT, and their TET. Then you will now write your reports and quote these things because you are asked to prepare a report addressing to the managing director showing all the relevant years capital allowance computation. So you just say the capital allowances have been computed for the relevant period, you quote the period, and they are as follows. See that box that you just put down there? This is what would have been inside your report, that summary. Put the year of assessment, put all of them. That way, inside your report and you conclude. That's all. Say, see the appendix or the workings here or appendices to see how all of these were derived. Should you have any question about any of them, feel free to contact me. That's all. You've written your report. You've made reference to the capital allowance computations for each year of assessment and the tax liabilities. You could as well include assessable profit or adjusted profit, capital allowance, CIT, TET. It's fine. Even though they didn't ask you for the adjusted profit, if you have time, you can put it. But because normally it is from the adjusted profit that you claim your capital allowance and your CITs, you might decide not to do that. You might decide to also do that and put your taxable profit here too. This one and this are optional. You are not asked. If you have the time, you can put this. If you are doing a comprehensive report, in real life, you need to put this. Accessible profits, capital allowance, taxable profits, CIT and TET. And your work is very comprehensive. So with this now, we've said goodbye to part 2 of capital allowances. Capital allowances is a deep topic that your skills in this topic needs to be enhanced and strong so that you can face the computations in the exam. This is one area where your expertise will need to be tested. So for the next class and the class that follows, we will still be doing capital allowances. There are other areas of capital allowances we have not touched, especially the work back, carry back capital allowances. We've done hire purchase, yes. We've done the other one, the normal one, which we just did. We've not done the one of restriction. We've not done the one of restriction and the carry back of capital allowances. So we are going to be seeing these ones in the next 2 classes. So thank you so much for the time spent in this class. The lecture notes will be the materials will be sent to your emails, your video will be sent to you. So once again, I say I give you my appreciation for finding the time to be in this class. Until then, I'll say thank you and good night.